All right, a question that we frequently get, and I'm sure it's on top of everybody's mind here, is what does the note market look like? Well, because of the fallout from the 2007 to 2009 financial crisis, there's millions of loans that are underwater, and they still remain underwater in many areas. While many markets are coming back, and of course, real estate, all real estate markets are local, so it depends upon where you are in the country. But primarily for our interest in the Rust Belt states, Indiana, Illinois, Western Pennsylvania, West Virginia, North Carolina, all those states there where they've been hard hit by the marketplace, by the market collapse, there's lots of properties there that are still underwater or valued less, or they're struggling, or the people, because they've lost jobs, illness, lots of various reasons, are not able to meet their mortgage payments. So there's a lot of distress there. Banks are not helping borrowers recover. The sad truth is, even though the federal government has programs to encourage banks to help people recover, HAMP and HARP and several other ones, they don't do it because banks are not in the business of managing real estate. Banks are in the business of loaning money, collecting payments, and getting rich. Okay? So what we want to do is we want to become bank and loan money, collect payments, and get rich, get security. Okay? Federal programs like HAMP are not working. The HAMP is the Home Affordable Modification Program, et cetera. The other thing is as we're slowly digging out of the recession, the Great Recession, a lot of mid-sized and regional banks have hung on to loans that are non-performing. And slowly it's catching up with them because the international banking rules and federal banking rules have begun to tighten their credit requirements, their reserve requirements. And so they're needing to get this bad paper off their books. So they're now starting to come to market with some of those. And a lot of those are being sold through hedge funds, to hedge funds, and the hedge funds are then passing them on. Fannie Mae and Freddie Mac are selling their assets, and they've got lots of them. They're currently, over the last 2 years, they've averaged about $15 billion a year in loans, the unpaid balance of those loans, about $15 billion a year. Okay, let's go to the next one. Bank regulations have changed, and banks that when their minimum capital requirements fall below a certain percentage, they end up being bought up by or forced out of business by the FDIC. Another thing is that many of the loans that were modified in the 2009 to 2011 period, those are resetting because the banks merely lowered their interest rate and cut the monthly mortgage payment, and may have taken and pushed missed payments out into the future or added it to the end of the loan. So the borrower still owes a lot of money. And now when the interest rate resets, what happens? The monthly payment goes up and people can no longer afford it, and those are beginning to default again. Okay? An important thing here is just these two, Freddie and Fannie, have over $126 billion in unpaid balance loans that are in default. 120, and if they're selling $15 billion a year, how long is it going to take to work out what's currently on the shelf for them?
That's an important point. What's currently on the shelf, that's not anything new. Right. There's also FHA and HUD. So there's a heck of a lot of debt out there.
VA,
the VA.
HUD. Mm-hmm. Yep. Oh, and there's almost that amount in regional, local, and other banks in the country. Mm-hmm. So we're looking at, my guess is that everybody seems, well, the banks are at least smart enough to know, and Fannie and Freddie, the GSEs and the government is smart enough to know that if they dumped all of that paper at one time, they'd probably crash the real estate market, which doesn't do anybody any good.
Right.
And particularly the county assessors and the county treasurers would really be ticked off because they can only charge taxes on the current value of the property, and suddenly their tax base goes to zip, and that's not a good thing. So anyway, it appears that these assets are coming to market at a pace designed not to crash or depress the real estate market. And I'm guessing at the current pace, we have at least 5 to 7 years of inventory coming to the marketplace. And
Just what's on hand
ju-
right
with
now.
just based on what's on hand. And the default rate, I think during the Great Recession, shot up to around 3.5% to 5%. The normal default rate is about 0.75% of the mortgages in the marketplace. So we'll still be coming to market. Okay.